kind of hated that. I think that recorded. Okay, cool. Did everyone get a notice of the record just now? Because for some reason it didn't give me a sound. Okay, cool. So what we're looking at right now is just the ES, Standards and Poor. And let me see if I can get these screens out of the way. Cool. And so then the way you kind of see my chart here, I'll just start with a daily, makes life a little easier. So what you'll see here on the daily chart is just the series of the ES futures that has just basically been running. Clearly you see at this point, we've kind of tapped all-time highs and we're pumping pretty hard right now. So that's obviously what a lot of your positions are running today. So protect yourself, get out if you need to. That's kind of what I would look at. Other than that, what we'll kind of start with a little bit is I have to kind of go back a little bit about futures. And with that, we'll kind of go over essentially, if you're gonna kind of look to trade futures, essentially it runs 23 hours a day, 5 days a week, closed on Saturday, reopens back on Sunday. It's multiple instruments that you can trade. You can trade the ES, which is basically the futures for the Standard and Poor. We have the NQ, which is the futures for the NASDAQ, and we have the YM, which is futures for the Dow. They all have different tick values. They're measured in ticks or points. Your ES will be $12.50 a tick, $50 a point. Your NQ is $5 a tick, $20 a point. YM, $5 a point, no ticks. So to do on NinjaTrader, you'll have $500 intraday margin for the ES and the Dow, $1,000 margin for the NQ. You have the bonds as well. That will have the ZB, which is the 30-year bonds. Most people trade those. If you had Jada Trader's course, he specializes in that. That's $500 intraday margin as well if you're going to trade through NinjaTrader. Obviously, most of this stuff's kind of somewhat related to NinjaTrader because that's kind of the cheapest margins they have going. If you want to trade through another platform, you'll be probably supplying the whole initial margin, which is about 13K, give or take, depending on kind of the platform as well. So your tick value on your bonds are $31.25. From there, essentially what you want to do, once we got through kind of the money part, what you're typically trying to do and what your goal of futures trading is, you're trying to read the price action and you're trying to read candles to where you say, I believe that the market is either going to go up or down. That's what makes futures very simple in that regards. So it's either going to go up or it's going to go down. So either I think the market's going to come from 43.73 and go down, or I believe the market's going to go up. So the margins for the micros are 50 bucks. It's all 1/10 of the bigger instruments. So if with that said, if you need $500 to do ES, then you just need 50 bucks for the micros. So just anything that's the value of that, the micros are 1/10 of that value. So, and that's what I really suggest anyway. If anybody's actually wants to get into that, I'll just address that right now. So essentially, like, futures are a great way to have some income, great way to learn price action, things like that. I will say it's, people get pretty ahead of themselves when it comes to futures. So you want to have a little bit of a bigger account to have the proper risk management when it comes to futures. That's why they created kind of the micros. So personally, I like to do 1 to 2% of my account per trade. And what does that mean? That means that if I'm willing to risk, not so much the actual margin, if I'm willing to risk 250 bucks, I need to have $25,000 in my account. The two things that does is, one, It gives me 99% of my account left if I ever lose. And also it keeps me like nice and calm. So you should be able to, wow, the ES is crazy. Yeah, so you should be able to basically have a trade and be calm in it. If you feel like you're nervous right away as soon as you take the trade, you either bought too much or you're not ready. So you want to make sure that you have a proper risk reward, make sure that all these things are correct, and kind of go from there. Wow, 4,400, that's wild. Is anybody still in positions? Y'all need to get out if y'all still in them. Just FYI. I'm just about to get out. So this gonna be on the recording, is what it is. I'm selling because I had 10 of them, so they are gone. All right, cool. So the other part of that too is you want to have kind of proper risk reward. That's the main thing that you're looking for within this area. And so you want to say, okay, if I lose, I only got 99% of my account left. That's perfect. Now you get to a point where you're trying to do, all right, perfect. Yeah, when you're trying to do all these different things of saying, well, I'm going to say I'm going to risk 30% because I'm going to get that. A 30% hit is ridiculously hard to your account. So I want to say like you start at the sim, and then not only that, you want to start at the sim with the money that you're going to literally put into your account, not 100,000 like everyone says, not any of that stuff. You want to actually put, say if you're going to put $500 in, put $500 in, and then go to the micros and start working your way up that way. And then kind of, and personally, I would say sim for 6 months. You know, everyone's different. People want to get on the train quicker. I don't believe in the skin in the game part per se with high risk. I'm okay with sim trading when you're good enough and then moving to live on the micros. You know, sim fingers are very brave. You know, I would say if people ask me like what percentage do you need to have win rate on sim before you go live, I would say damn near 100. Because what will happen is that percentage is going to go significantly down when you go live. So I'd much rather you do a little bit better in sim, and then once you get to live, then you can kind of say, all right, I'm going to go to micros, risk one contract, and then depending on your stop loss and ATM, that's always a big thing. Never trade naked without a stop loss. This is like 2 things that have happened, you know, in the last couple of my conversations with people in the last couple months. It's like I traded, I didn't have an ATM set. So I'm like, why did you not close it? Well, I thought it was going to come back up to me. That's the wrong attitude. Like, just close it. Like, and there's obviously ways to click your ATM in. I'll show that at the end when I bring up NinjaTrader, but there's ways. And if you look at the video, honestly, the beginning video will show you if you get into a trade, you can click the NinjaTrader up. So, but that's what you want to do. You definitely don't want to be sitting here trading live without a stop loss. That's the reason you have it. Obviously in futures, totally different than options. You can put $500 into play. If you lose, it's $500. Futures, you have no stop loss. It will wipe your account out. They'll just close your account out. Whatever that account is, it'll keep going until you hit close. So no raw dogging trades, none of that. Trust me, you will pay dearly. So now that we got that out of the way, ATMs, smaller risk management. If your skill gets up there, you don't have to buy the license. You can go get funded if you want. There's funding areas as well that'll pay for your skill set. And you can use the funding to eventually pay for your license on NinjaTrader if you want to leave that funding. Up to you, however you want to do it. For anyone that's new, there's a lot of rich people. God, look at the ES. You gotta be kidding me, dude. How does this happen when I have to give this class? So funding, so when you're doing your funding, there's a bunch of rich people that will just pay for your skill set. If you're pretty good, that just says, hey, I'm pretty good at trading futures. Then you say, okay, well, they're gonna give you a sim account and an evaluation to say, can you be profitable? Can you be profitable under our rules? And if you are, you pass your evaluation, then you basically have to do it all over again. to kind of avoid your trailing drawdown. We'll get into all those details at another date, but this is just the kind of nuts and bolts of kind of combines as well, because you probably hear stuff about combines are being funded. So once you're funded, then you can start building your account using that as liquidity, and they'll take 80-20. Basically, you have 80%, they'll take 20, you build your account that way. And then if you ever want to leave, with most funding firms, they'll give you the license while you're trading for them. Once you leave, the license is gone. So if you ever want to get in that situation, just build your money up and you can buy your license that way and buy your account, or you build it up, use your money, get a license, and then trade for them as well. So you can have 2 accounts. So kind of however you want to do it. But the other part of that too is when you're looking at futures, like from a holistic standpoint, it's really just, for lack of better words, it's literally just price action. And the better you can read price action, the better you can trade futures. Now, when it comes to this stuff right here, yeah, I mean, that's just crazy town. I think this is setting us up for a drop, but this is just crazy town. I mean, this is not normal action. So I'll show you some normal stuff while this is pumping like crazy. But when you're looking at futures, the main thing that you want to look for is say, okay, you want to always start kind of somewhat in a higher time frame. So I like to start, sometimes I like to start in a weekly, but today we'll just kind of start with a daily. And I'll take some of this stuff off and then I can redraw it. It's not a big deal. And we'll go over gaps and all that fun stuff too. But the main thing you're looking for is you're just looking at, and each candle represents a day. So you're just looking at how the day is going and how each thing is moving. Now, if anybody's ever done any charting, things like that, you kind of want to look at, if you want to, if you're kind of a chart nerd like me, you always want to look at trend lines. And when things stay on your trend line, you don't typically get nervous about a quote unquote drop. The SPX is still like crazy pumping. So when you're looking at like an overall macro view, a drop is necessary to get these things cleared for a little room to go. So this is kind of what happened here. This is that Thursday, Friday, Monday, and then we have Tuesday, Wednesday, Thursday, and it completely erased what you thought was happening. And all it really is just basically getting us back on the trend line, clearing a lot of this downside up so we can clear the rest of it up later. And that's kind of what I'll get into a lot later in the discussion. But I like to look at dailies. They kind of tell me where our overall trend is for amount of weeks, days, whatever. So obviously you can see up here, when we got up here, this was basically all kinds of consolidation because we're just hitting all-time high after all-time high after all-time high. And so now we're obviously pushing like absolutely like crazy right now to get to some destination that I have no idea at this point, because once you get up here, there is nothing up here. So with that said, when you're trying to trade futures, you are not buying the tops and selling the bottoms. So if you see this trade up here, you sit on your hands and leave it alone. Like, I mean, and it requires and futures requires a patience, unlike options, trust me. The concept of futures is easier. The execution is harder because this is staring at you all day. So if something goes against you, something comes around, something basically like says, okay, no, you're about to lose money today. You got to sit there and watch it. Now, options is different. You can be watching a chart, your premium can move up and down, left and right, whatever. This is just, it's got one direction against you. Like say if I was shorting, say if I said I thought the market would fall. A lot of people said, okay, once we get up to, we break this high or 44, whatever, 43.90 or something, the market's going to fall. So if I tried to sell this at 43.90, I'd be down 20 ticks or 5 points at this point. That's 5 times $50. And if I'm trading multiple contracts, that's how much I'd be down. Now, would you be right? Maybe. Depends on how long you can hold it. But this is the things that mentally come in when you're basically trying to for lack of better words, predict the market. Now, what I typically want to do and what I typically try to teach is predicting this, not so much predicting whether this is going to come down, especially if you're in a trend where the market is going up. When you look at, and I'll kind of go over this again because that's probably new too. So when you're looking at your setup for a futures, you want to look at an institutional day. And most of you guys are probably East Coast, so I'll just switch it to make your life a little easier. So your institutional days are based on the East Coast anyways, based on New York. So your institutional beginning days are midnight to midnight or 0 hour to 0 hour. And then you want to take those highs and lows and you want to chart those. It's not an indicator. I just draw the lines. I know there's probably some indicators out there, but I don't really care. So from there, and it's good practice to really just chart these things and really see it personally. People use indicators for like kind of almost everything, but then you'll probably have like 30 scripts for something you could just chart. But once you look at it, you'll start to see the trend of the week, obviously. If you look back at last week, you'll start to see that we topped out and we started to go down. Now, there's a few things that happened last week. If you look at it, look at the range of last week versus the range of this week. Now, as we get closer to the end of the week, you start to see that range get smaller and smaller. So what that tells me is we're probably squeezing into, a little bit of a downside action, probably, at least to kind of retest a few things. I personally believe we still got another week or so, maybe or more of tech running, but it's up in the God's hands at this point. But what you want to do though is you want to start your week off basically Monday, Tuesday, Wednesday, Thursday, and then obviously we're at Friday. Now, once we set our Friday time, we'll set that, we won't be done, and we'll basically be done when the market's done because the market closes on Friday at market close. There's no after hours, maybe a few minutes or so to settle, but it's not any after hours. Now, when you set up your Sunday, I don't particularly look at Sunday because there's not a lot going on. Some people trade Sunday, good for it. I mean, like I don't do it, but that's cool. But this is basically the end of Friday. And then here's your Sunday area in here. And then it begins on Monday. So what this typically lets me do is it lets me say, okay, where is the market trying to go? Now, typically most things that'll happen is the market is trying to get to liquidity, and liquidity is typically found above the previous day's highs and below the previous day's lows. So remember that. Also, typically liquidity is found in gaps. Now, what are gaps? If you don't know what gaps are, we'll go over those real quick. So gaps are basically a price imbalance where the price runs away very quickly and doesn't come back. And so basically it leaves a gap or basically a missing link in the price action of the market. So if you ever feel like you've set a limit order, the stock takes off on you, you got to bump your limit over, then bump your limit over, then bump your limit over, like limit order up. That's what's happening. So what happens here is when you're looking at this and you're looking at futures contracts, every tick, which is 0.25 on the ES, has like hundreds of thousands of orders in it. Like if you ever look at the volume on an actual hour bar, it's like, basically 200,000-300,000 orders that get put in. That's not the orders that are placed, that's just the orders that are filled. So what happens is once you get a bar like this, and then you get a big bullish bar and then a big bullish bar, these skip a lot of limit orders that'll sit here. Now, just like anything, they're not like retail. They're not going to change their price. Like the price is what the price is. So they're going to wait and it's going to come back and fill them because obviously they kind of make the market. Now, when they come back and get this one, we'll see when they come back. But essentially what you're looking at is you're looking at a couple gaps here, but we can just handle the bigger one as we see right now. We want to look at a combination of bar A, B, and C. And the gap is created when bar A comes up, bar B shoots past it, and this is the bar that skips a lot of limit orders. Okay, so you got to remember that. This bar here, bar C, does not come down to help fill the orders from this bar. So when this bar doesn't come down to fill the orders from this bar, you have a gap in price between bar A and bar C. Does that make sense? Or do I need to kind of go over that again? Okay, so then when you have that gap and you want to draw it out, typically all you want to do is kind of draw it in between these areas. And so then if it comes back, and it's the same thing. So then you have a bar here. This would be bar A, B, C. So now you have another gap here. And then if you look here, we have another one. Now, when we get these gaps, sometimes they get filled right away. Sometimes they don't. Case in point, if you look here, this is bar A, bar B, bar C. So see how C does not come down to meet A? So then when you have that gap, you'll have it here, but you notice right away what it does. The market comes back down and fills this gap and then retraces back through it. So typically when that happens, I typically will wait maybe 1 or 2 weeks or so and then remove the gap. But that's essentially what happens is if it comes back down, it'll fill the gap and then the market is back to balanced. And so that clears us for takeoff. That's kind of like your typical area. Yeah, I know, boy, it's 4407 and it's 4400 in the ES. It's wild. Yeah. So the other part that you want to look at here is every time we're hitting a high at this week, typically we're not reversing. Before, we typically would hit a high and then we would verse the other way. Now here, technically, we did hit a high here and we broke the previous day's high. This is London. Technically, we reversed, but we took off again. So reading this is not always, it's not always 100%, but looking at some of the things they'll help you during like your, basically your price action. Now, what I mean by price action is looking at the relationship between, I don't even necessarily say buyers and sellers, it's more so the relationship between the candle, the price levels versus kind of like what else you're trying to look at it. What I mean by this, because I'm trying to explain this in a macro, so I don't get too detailed. You're looking at how price reacts at a certain level. I'll just say that. And so when you see a certain price react at a certain level, you're looking at kind of what is called like just basically price sensitivity. If it gets up here, it may sell off. Gets up here, may sell off. Now, I'll tell you, for the most part, when you see something like this, and I'll zoom in, if you see something like this, where almost all your highs are equal, I can probably guarantee you 100% they're gonna get hit. Now, in futures, unlike stocks, they will tell you this is resistance, because you can see it come up and up and up and up and up, and then it gets blasted. They'll tell you down here, this is support. And then it'll come down, smack your stop and go the other way. So I don't necessarily disparage support and resistance. I more like reword it, because I think support and resistance is not a proper way to look at the futures market. I would say more along the lines of price imbalances, maybe a little more supply and demand, and liquidity is kind of where I would say the futures market kind of lies. Now, I will say this. No, I won't say that. Never mind. I'll do that later. So the futures market essentially has these areas where when you're reading price action, you want to kind of let the market dictate what you're going to do. And you don't want to like force and counter trade a trend. That's kind of the main thing that we want to do with futures, is we want to look at the trend. And that's the part of like dictating and looking at your levels from a macro point and then going into a little bit more pinpoint. So when you're looking at a week like this week, we had tech earnings coming up. This week here, traditionally, and we'll see it again next month, traditionally, what will happen is end of the month expiration, they will sell. That's kind of your normal week. Now, did we break some highs? Yeah, of course we did. But on your bearish weeks, typically what happens, you'll make your highs between Monday, or 70% of the time, you'll probably make your highs between Tuesday and Wednesday on a bearish week. And on a bullish week, you'll probably make your lows between Monday, Tuesday, and Wednesday as well. So you're typically towards the end or towards the beginning of the weeks, you'll get your highs and lows. That's kind of where you'll basically see them. And so then once you kind of crack your lows for a bullish week, it's kind of all jets, basically. And if you believe that the week can be bearish, meaning it can be selling, it can be quad witching, it can be, bad numbers coming out, it can be anything macro, you can kind of see that that area was going to eventually sell off. Another key point for people that trade futures already, whenever you see even lows, just know the market is coming to get it. So you see this on an hourly chart where you can see even lows, even lows, even lows. Every time there's an even low or an even high, it is coming to get it. I promise you 100% it's coming to get it. It is not support. It is not resistance. It is a setup for you to get smacked. And so if you look at the ES today, we can even look at it today and go down to like a 15-minute chart. So let's look at a 15-minute chart. And if you guys are okay with me freestyle, I'm just gonna freestyle. I don't really like formal lessons, I'm not gonna lie, but I'll just kind of like spew out what I love about futures. So you see this area here. You see how the market was basically kind of setting you up to say that the market might drop. If you just set a line right here and let you know, hey, that's resistance. We came up, dropped down, man, that's crazy hard. Came up, here's your equal highs. Came up, dropped it down, market's about to drop. No, it isn't. And that's what'll happen every time in futures. I'm telling you, like, I promise you this will happen every time. And so what I typically want to teach people, and also what I know about futures, is the people that wrote the books are the same people taking your money. And I want to be like clear about futures is that it's not a game. Like, it's really not. I'm telling you, I joke a lot. I will say that because I'm just out of a trade. But when you're in here, it is a war between you and another bank. You are not trading against people. You may be trading against very clear professionals, but when you win, someone else's lose. It's the same thing with options. Like when you sell a contract, say, oh, I hit SPY for 200%, you took 200% from someone. Like, that's how I'm like, it's not, oh, the market maker just has this contract. No, they make the contract and then someone buys them up to sell to you. And then once you buy it and you hit it for a certain percentage and sell it back, they lost that money. So the main thing, no, don't feel bad, trust me, because they'll do it to you. They will take the money out of your kid's mouth and smack you in the face open-handed and walk away. These people do not care, I'm telling you. So the main thing that I'm kind of looking for, and what I tell people about futures, is you want to be 1, patient, 2, diligent, 3, study, basically past price action. And also you want to kind of read the macro of the market. Like, what is the market trying to do? What's the narrative out there in the market? Oh, we're going to tech earnings, we're going to all-time highs. Okay, cool. You hear about September correction all day. It's all we've been talking about. So when they set you up with a September correction, just better believe it's probably coming in August. So the reason I say that is just because I want you to kind of have the mindset to get out of a retail trader's mentality. I mean, like just completely get rid of it. And it's going to be hard, I'm telling you, but the one thing you want to do is look at a chart and start looking at where would I place my stop if I was selling the market or if I was buying it. Because if I said, hey, this is where I would place my stop, they're going to come hit it. So if you look at here, you see these equal highs. So if I drew a line right here, look where this goes. It goes there for a second to hit your stop because that's not resistance. And then it just runs off the other way. So I can show you kind of clear examples that this happens all day, every day. But the one thing I kind of want to like look at a little bit too is just your different instruments. Like everyone's like enamored with the ES. You don't have to trade the ES. It honestly doesn't have the best price action. If you really want to look at kind of different things, you can look at the currencies, or you can look at, I mean, everyone's crackhead friend NQ. It's kind of fast. Or the YM is kind of a mix between the two. The bonds are nice and slow. UB's on crack a little bit, but those are kind of nice. No, you don't necessarily need to do Forex. It's more, you can do currency futures. So you have 6E for the Euro currency. So if I went there, you would see the European currencies here. You would have 6B, which is the pound currency, 6A, which is the Australian, the Aussie, 6C, which is the loonie. So you have 3 different currencies that respond to basically 3 or 4 different sets of news. So that's why when we look at Forex Factory in the morning, it really has everything to do with currencies. It just so happens to affect the indices a little bit, but it affects the currencies every day, all day. That's why they have the nation next to them, and that's why they have whether it's red or green or yellow or whatever. So, but that's kind of like what, you know, the options that you can have and the little things that you look at. Now, when we're looking at like something like the ES, I would say that the allure of it is, you know, because it matches with your stocks. So if you're trading a SPY, you want to look at the ES. I get that. I would say if you're trading futures or if you're looking to get into futures, personally, I would probably at least start. I would start with a currency like a 6E or something like that, just to learn price action. Not saying you got to trade it. But the ES will do all this kind of funky stuff that you just like not ready for. And it won't be a situation that is beneficial to you. But I mean, it has its benefits too. So that's kind of like one of the other things. Now, the one thing I like to do, quite honestly, is I like to alter my charts to where I trade off the 15-minute, but I look at the daily 4-hour, 1 hour. And when I get to the 15-minute, I still keep my highs and lows just to kind of see where I'm at in the marketplace. Wow, this is interesting. So did that hit 4,400 on the dot? Yeah. Well, that's ironic. So that's probably our top today. Just FYI, if anybody wanted to know. Oh no, I'm not regretting. No, I see it though. This is over now. Might as well short it from here. So main thing that I'm looking at too, though, when I'm trading futures, like when we get into this all-time high territory, I mean, kind of all bets are off. I'm not even gonna lie to you. Like this is a very hard area to trade because you need to have a target in mind. So you never want to get into a futures trade where you don't have a target, you don't have an entry or an exit, like in a stop loss. So I would look at maybe something that doesn't have an all-time high, and that's currencies, interest rates, ZB, UB, none of these things have, I mean, they do have highs, but they don't necessarily get there in these all-time high area. It doesn't have an objective to kind of get to an all-time high. Like the ES is always going to be wanting to go up. I mean, that's just kind of like how the nature of it until it doesn't, obviously, in a couple of weeks. But that's kind of like your normal thing when you're looking at this. I don't like to use a lot of indicators. I'm not gonna lie to you. I don't really use them. But what I typically like to do when I'm trading is I like to read the London first, so I'll kind of go through. Yeah, I can probably back up here. Yeah, I can back this up. Cool. So I'll typically kind of look at London. So, oh wait, let me change my time zone. It's confusing me here. So I'll look at the London, which is obviously super late for you guys. So where is it? Yeah, so we'll just back up here. So we'll just kind of walk through a little trade real quick and see. So when I'm looking at something like this, you'll see kind of a gap area here. It's kind of an area of interest, kind of junky price action, not gonna lie to you. But this is kind of our high for the day. Clearly this is left here because it's gonna be our low. So you wouldn't necessarily know that going into the trade. But the main things I'm looking at here, I wonder if they'll stop it at 1 hour. Yeah, perfect. Okay. So what I'm looking at when I'm setting up a trade is, okay, we obviously pierced yesterday's high. I'm looking at a gap here. So that potential downside. My potential upside is here above that high. And we've already gotten into this gap here, if you look at it. So we've kind of already gotten here. And then these are kind of some of the areas that we kind of look at for our going up. Now, when we get into a lower time frame, we can kind of play out some candles and see. Now, in this area, we're looking at basically, this is the end of the day, and then we're going down, and then here is our Tokyo Asian range here. So we're looking here, and we're gonna bring that there, yeah, perfect. And so then now we're starting to just read some candles, and I'm looking for kind of where the price action is gonna go. And so then we'll see we dropped down a little bit. We tried to pierce here, we did not get there. And so then we're dropping down and kind of in the middle and chilling out a little bit. At this point, honestly, that's the part about futures is it's very boring. You got to sit here and wait for a while. And so you see that the market's trying to push it down lower, and you're trying to get into here. Now, if anybody kind of trades futures, you'll kind of know what this area is a little bit. And I'll kind of explain that a little bit later, but you'll kind of see how the price reacts off of this level. And you see that, how it jumps back off of this level. So that's kind of an area of interest, and you see how it jumps again. So it's not resistance. What it is basically grabbing orders from this little area here. And so you see that once it gets it, it shoots up and it's gone. And so then there, this is where you'll start to see that the market tries to trade back into this area. And so now it has the ability and the want to get up now, because it hasn't dropped below the Asian low yet. And so you'll see it kind of dropping into place. And you see how that reacts off that level again. So we have a sensitive level here, and we have another level that's still here. And so once I see this, and I see this action here, and then we're looking at time though. So obviously in this area, we're looking at right before the London open. So now if this is selling off and I have this sensitivity in this area right before the London open, I know all I need is volume to get that way. So at that point, I would enter the trade here. And then I just wait. Oh, well, I didn't know that was going to happen. But essentially all I'm waiting on is volume at that point. So clearly I got the volume. And so from there, I'm just kind of holding on and seeing how the day goes. So now once we shoot up here, obviously this is, personally part of my first target. And then we kind of go from there and move the trade up. And then we kind of work the trade as we see fit. Now, at this point, I'm pretty excited because then you see equal highs when you're going through here. I don't really care that this comes down. I entered down here. So I typically will protect profits, cover my entry and see where we go from there. But I'm pretty excited about this equal high because we all know what equal highs do. We get them smacked. So you see how that reacts off that level again. And so it shoots back up. Now, here's the crazy part about futures, though, is it doesn't always just sit here and do this. These are 15-minute candles. So for 15 minutes, it's coming down at you. So you got to have the mental fortitude to say, I'm in the right trade. I picked the right direction. And it can sit down here for 10 of those 15 minutes, maybe even 13 of those 15 minutes, and then start working its way back up. So I think that's why I think futures is harder. Maybe, someone could correct me if I'm wrong. But from there, these are the retracements that I'm looking for to come down. And then I look for this price action to move up. This is my area of target. Because once you see this entices people to short the market down. As I said, it's basically you can't get past that level. So now I'm just waiting and seeing if the market decides to agree with me today. And so once we kind of see it go up and we're seeing it kind of play out in this little weird junky action, now it's starting to target this area. If everyone can see that, it's literally targeting that area. And it's just slowly getting up there and slowly ready to kind of come smack that area. You see that? It's enticing people to short it even more. You see how I just blasted? You see how it comes back down with a wick? Because it got everyone that was trying to short this market. And so at this point, my entry's down here. I typically would probably put my stop somewhere around the 5-point range or so. And I just let the trade work at this point. And then at this point, I probably would have got stopped out right there if I got aggressive with my take profit. But most trades, I just kind of cover my entry and let it work. But depending on kind of how the day goes, you can probably just get stopped out. But those are kind of like my first target. When I see this equal highs, that's my first target to hit. So now once you're out of the trade, it is what it is at that point. I mean, you don't really want to do too much because we're scalping. Like we're getting this money, getting out and moving on. Now, whatever the market does after that, it's none of my business, really. Wait, what? Sell, stop, market, or limit. Oh, I just limit. I don't do anything market. I get the price. From what I personally, I get the price I want, not the price they give me. So, so now we're looking at a situation where we're going lower. This is an enticing to get people to buy the market up, but this is starting to go. This is a want to go lower. And then at this point, you'll see that it reacts off that level again. Do you see that? So you see how this reacts off the same level? And so you're just reading the price action of how it reacts. And you see how it keeps reacting off of that. But if it keeps going there, it's going to eventually knock through it. And then this is how futures will kill you, because you have this trade, you work this trade out, you won this trade. If you don't take profit, this is how the market will reward you. Now, say you didn't get up for London. Let's just say that, and that's perfectly fine. We don't typically need to get up for London. You can just read price action and say, okay, oh, cool, we broke the previous day high in London. So let's see where we might trade down to. So when we look left, which is kind of what you always want to do, you see this gap here. The main thing that you're looking for is it's going to probably trade down into this gap. And so when you draw this out, and I typically draw bodies to bodies, everyone does wicks to wicks sometimes, but I find that with your brokerages, you can get a different size wick. And I hope I didn't alarm anyone of that, but it's a possibility that your wicks can be different sizes based on the brokerages, because you're getting basically placing the order through them. So anyway, that's a whole other conversation for another day. But when you draw your gap, you see where this comes down to. So you don't necessarily have to trade like OTE, but you basically need to know where gaps are because they're magnets to price. So from here, if I see this react like that, then I'm ready to go long at this point, but I gotta wait though. I gotta wait because I'm pretty sure, yes, I'm pretty sure there's probably some news coming. So you just kind of see how the market wants to get through and kind of react. To me, that's still a short, I was about to say. And so then from there, we're just waiting. But you can see that there's a want to try to get through the gap. It just can't get through it. But if you keep knocking on the door, eventually it's going to get there, and then the market kind of changes a little bit. But here, let's see. So in this area, when you see candles like this is obviously the volatility that some people want, a lot of people don't want, but you're going to get this on the opening candles because it opens at 6:30 for me. So once you kind of see this area here come through and shoot through, this is basically kind of gathering orders to try to get up. Now, do we get there? Who knows? There we go. And so then you see how it's trying to get through the gap now. So once we get our closure in here, you better look out, because if this can't get out of this gap here, it's coming down. Yeah, that's easy enough to see now at this point. So now obviously I knew this low line because that was there, but reading the price action before I even knew that was coming down, you want to kind of look at closures and things and see how strong candles come down. That's the whole point about reading price action. Now at this point, you know, the market kind of does what it wants to do, and it'll probably get up here, and that's kind of end of it. But you see how when we start to go up, you see how it prints equal highs? Like this will keep doing this all the time. And then once you see it, it's gonna bust them every time. And so then now at that point, the market has decided that it wants to go up. It's gotten taken care of its downside action. And then you kind of go from there. But that's kind of how I would set up like a trade normally. And I'll just kind of end that. That's how I would set up a trade like in London. And it would just be a quick little scalp. Now to catch the whole day's range, everyone wants to do that. It's not the easiest thing in the world to do. Especially like if you look at something like today. If you're looking at, let's say if you're looking at, I hate looking at all-time highs. I'll go another day. Because at this point, the market's just going to really sell it off at this point. Oh, you want to look at UB? Okay, we can look at UB. That's perfectly fine. As you can tell, I've traded this a few times. So we'll go in depth for UB and kind of throw some sauce on the UB, and then we'll probably call it quits because I think everyone's got to go. So we'll look at the hour chart on the UB, and you want to do yesterday, or it doesn't matter what day. I guess it doesn't matter. So what was just, well, yeah, it would be here, right? Is that what you're talking about? Maybe you're talking about the 20th. Are you talking about here? Oh, okay, 22nd. Let's see. So the 21st going into the 22nd? Okay, cool. All right, yeah, all right. I will go, oh yeah, I have to do a different, because it's not gonna let me rewind it real quick on that one. So let's rewind it, and then this will kind of be even more fun because then I won't have anything marked up. I'll just be kind of reading it with you guys. So that'll be kind of more fun for me. Let's just go backwards. Okay. So as you can see, the UB actually moves pretty aggressively most days. So let's see, 22nd. Okay, cool. Yep, okay, cool. So we'll look at this price action here. And let's see. And this is an hour chart right now, but I'm gonna flip here in a second. So I like to look at a 15-minute. Okay. Okay, so then when we zoom out, we're looking at obviously you see these equal highs here. We haven't quite hit them yet. But if you see these equal highs, obviously that should tell you something, and you look back. And you look here, these are gaps in price here, and obviously a bigger gap here. So if we know, like anything, gaps are like magnets to price. So if we start to see the market trade down a little bit, my eyes are here initially for where we're trying to get to as far as a price level. So then we'll see kind of the market and see what it does. Perfect. Okay, so you see that the market's trying to get up here for a second, and then we shoot down. You see the same thing happen here, where we kind of shoot down, and we kind of basically, oh, I remember this day. This is funny. I kind of remember this day now. So what I'm looking for is, it's this area here. Hold up, I don't know why that changed the gap there just now. Because that's the range right there. Okay, so what I'm looking for, you see this area here? So this is from the end of the day to the beginning of the day or future. So there's a gap right here. And what we're looking for, personally, what I was looking for was it to trade down into this gap. And it's really just because the day ended and then began, and you'll see that in your futures contracts, you'll see that all the time, where the price gets readjusted. And so I'm looking for, this is our Asian range. So I'll kind of move that around a little bit. If that confuses everybody, just let me know. And then what I'm looking for is this to trade down into this gap. But I'm also looking for a bounce. And so that's what I'm looking for. So as soon as this hits this range here, we don't have a lot left down here. This is where we're going. I had my eyes kind of up here first. So this is what I was looking at. And I'm a pretty somewhat aggressive trader. So when you see, yeah, we'll just get into it. So when we see this action here, this swing, kind of more or less swing low action, you can see the reaction off of the price once it comes back up. This is technically what you would call, an order block. So when you see an action like this is technically what you would call an order block. I'll take the gap away since it's been filled. And they're hidden in plain sight, but this is where orders are stacked. When you see kind of a down red candle before the green expansion in the up, this is your order block here. And so then from there, it's gathering orders again. So you see how it reacts right off of that order block here? So once it hits that order block, it's gone. Now, the one thing I'm looking for is I'm looking for it to fill this gap right up here. This is my initial target, is to fill this gap body to body. So that's my initial target. And you see how we get up there pretty quick. And so now at that point, I'm pretty sure we got close to hitting it. Let me see. There we go. So you see how we're line for line there? We pierced that. That's my initial target. Now, whether it goes up here, I don't care. But that's my initial target because this is the closest place of liquidity that we're going to go to. At that point, I take my trade off and then I watch the market. So now, here's the fun sauce that'll happen. Right away, because the UB is kind of like on crack, you'll see an up green candle and a down red candle comes right through it. This turns into a bearish order block. So you have two different types of order blocks. You have a bullish order block, which is a down red candle. It's not any down red candle, but down red candle to an up green. You have a bearish order block, which is an up green candle to down red. So now at this point, whenever something comes back up into here, it's gonna trade downward. So now I'm just waiting at this point. When I see this form, I set my sell order right here and just wait. You see how that comes right up there to it, tick for tick? Now it's green and it doesn't really matter. You see how that's kind of trying to come up there and it may pierce it a little bit, but you see that right away? When things hit an order block, they run away very quickly and they get down quickly. So this is how you kind of read this price action, is that once these things get created, you set it real quick, and then you have to wait 30, 40 minutes, but look at that right away. And so then from there, now I'm looking at where are we trying to go? So we've already pierced our gap. We already have strong down movement from our order block here. Obviously, I've moved my stop up, and so now I'm just waiting. And so from here, I believe we're trying to get down to this little bitty area here because there's some stops down here. So for anybody that bought the market, right down here would be coming up. So now we're waiting to see. This is where my eye would be. So if you're looking here, this area would be where my eye would be for where we're trading down to. So let's just see what happens. So you see that, pierce that right away. Oops. You see that? See how that pierced that low? And so from there, I'm looking for this now to trade up this way. Because what it's doing is it's basically trying to go in and hit and swing back around, because these are called basically what is stop runs, or it's basically clearing out people's stops. So from here, let's look at what we do. Okay, so you see how we're trying to get up? Now here's another thing, because I'll actually back this up real quick. So now that we've had this candle go down, and this is going to go over a lot of people's heads, but you know, I feel like you know, you can grow from being uncomfortable, and the people that have been trading futures, they were asking for it, so I'm going to give them a little sauce since they stayed the whole time. So now that we have, remember when we talked about we have in this order block here? So anytime you have an order block here that's bullish, and you have a bearish candle that like literally obliterates it, it turns into what is called a breaker. And so what I typically look for on breakers are hourly breakers. And so here's your order block. Here's your breaker that comes down. The breaker turns into, and you guys can always watch it again and stuff on record. So I'm okay. I'm gonna go faster for the people in the front. So here's your breaker here. It's this range. Anything that trades within this range here is gonna be shorted back down. That's the theory on a breaker. So let's see what happens. So now we come down and we bust this low. So now what I'm waiting on is anything that trades within this range should be shorted back down to this line. So let's see what happens. So it comes back up. Most of the time when it does this, kind of gets a little scary. You see how it pierced this and gets rejected? Let's see what happens from there. You see how that's starting to get turned away? You see that? And now you just manage your trade. You see how that pierced the low? And so all because the order block got violated and it turned into what is called a breaker. So you see how it didn't come and close below that, and it shot down and killed this low. So now from there, I've taken it up, I've sold it down, and I've sold it down. So now I've had 3 trades right here, all before the market opened, while everyone's asleep. So now from here, now I'm looking to see what's the next price action. So this breaker's already kind of done. And now what has created is this huge area of liquidity here. So now we just see what happens from there. So we see that we're starting to trade up. And then at this point, when you see this again, and this is just me being aggressive, and I'm starting to get like pretty good about seeing these when they get created, is once you see this created down here, this will be your order block again. So now I'm looking for this to explode upward. And I'm wrong. So I got stopped out of that one. So at least I got 3 trades done. and it is what it is. And I'm probably sure, oh yeah, so it's probably a news candle, and I probably got killed. So 3 out of 4, not the worst thing in the world. Now from here though, if I really want to keep trading, now I know this is going up. So now I'm just kind of looking at where is this going to go up from here. And I'm kind of like probably, I'm not even saying angry, it's just probably like upsetting that I lost that trade. So then we just kind of look from there, and that's what the market does. So I won 3 out of 4. The fourth one, don't go into the fifth one trying to win it back. Let's put it that way, because that's how the market gets you mentally. And then it comes right back up to where you thought you were going. So that's kind of always the fun part about news candles, because I didn't really remember this day per se, but I'm pretty sure this is a news candle. Whenever you see stuff like this is a news candle, and it's just coming right back up to basically go where you thought it was going to go. So the one thing about that too is if you're reading this, basically I thought I won, bam, lost. If you're in the moment, and I'm reading Forex Factor or something, I know some news is coming, I probably just ain't in the trade yet. But that's just me kind of reading it right away. So from there, this is how disrespectful the UB is. It'll come back up, but notice what'll happen. And so we'll rewind this just for a second so you can see it. And this is how the UB will kind of respect a lot of things. So once we trade it down from here, believe it or not, this created another bearish order block. And the thing is that they're creating them all the time. They're just hidden in plain sight. So anytime something comes up here, I'm looking for this to trade back down. Now, the sad part is I'm not wrong about this order block. It just ran my stop. So that's the only sucky part. So you'll see that, and anything I'm looking there, you see how that hits this and reacts violently. And you see how that trades right back down into here. Now you should see this kind of stop around this breaker. If not, it could break down and come right back down to here. And there you go. So kind of a fun thing where basically you can play ping pong all day. But this is how you'll set up a trade. And honestly, if you're not, basically I'm trying to tell you every trade that can happen, but if you're not greedy, you literally can come from 197.29, and this was my initial target of 198.27. That's almost $1,000 right there. Then if you're looking at 198 down, 198.27 down to 197.15, so that's well over a point again. So that's like a point in 10 or 12 ticks or so. So you're looking at about 12 or 1,300 on that one per contract. And then if you're looking here and waiting for this to trade down to 198 and to take out this low again, so 198.04. And then if you wanted to just set your target here, that's perfectly fine. That's almost another point again. So those are kind of like the ways you can set up a trade. Those are the ways that you kind of get initiated into the matrix in some respects of how to read price action, but also how to see orders and how orders turn into different things called breakers in real time. So I will not be taking any questions on this at this point, because this is, just watch the video a couple times, dig into ICT stuff, watch this video a couple times. I promise you it'll start to make sense. But if you haven't dug into the material, going through this is the extra credit part for people that stayed, that have been kind of doing it already. So I wouldn't get into this too much until you're ready, and kind of deal with that. But I hope you enjoyed this part, and the other part I kind of helped to do it. But that'll be our last kind of normal, like, beginner future class, since we got the doors closed and we can kind of go a little deeper. Because this is just the UB. I mean, you know, we can trade other stuff all day, and kind of do some sick stuff. And that's only if you want to take all 3 trades. I mean, you can just take the first one and be done for the day. So that's just me showing you that 3 different trades that you could take, that you don't necessarily have to be up for London all the time. So Hope you enjoyed it, and I will see y'all later. Peace.